All right, this is Trading with Big G. This is Gino, Dad, however you might know me. And this is lesson 21, continuing what we talked about in lesson 20, taking the fear of trading, or taking the fear out of trading with risk management. So I encourage you to review lesson 8, and we're looking for layups. We're looking for trades with probabilities and controlling your risk. We're assuming that we're going to lose half of our trades. We're going to take small losses and want to try to ride the winners. We talked about why it's important to control your risk, because the more you lose, the more you have to make up to get back to break even. We talked about a rule of thumb and how much to risk per, or based on your account. This is how much you risk per trade. And again, the real key here is you risk what you're comfortable with. Risk a small amount, risk whatever you're comfortable with. If you don't like the percentage and don't like what that number looks like, risk what you want to risk. But keep it small and keep it manageable. Now, if you get into a specific trade, let's say you're looking at a chart and you want to make a trade, how do you determine how many shares to buy on that particular trade? So this is a risk management formula, and I actually have this written on an index card, and I keep it near my computer, and sometimes I refer to it when I'm trading. So you can take this formula, and as I break it down here for you in a few minutes, you may want to do the same thing. Just write it down on an index card, and this is just a quick little thing you can look at and determine, how many shares to risk, or how many shares to buy, and how much to risk for any given trade. So you're going to look at your account size, and you would put that down under the account size. You would multiply that times the account size of risk, which would be maybe 1% or 2%, 3 or 5%, like we talked about in the previous slide. And that would be your planned risk. And then you're going to look at your planned risk per share, and I'll go over that in just a second. We're going to figure this number out by looking at a chart, and then that gives you the maximum number of shares. So let's work through this. So let's say you have a $10,000 account. Let's say you just want to risk 1%. Well, 1% of 10,000 is $100. So your planned risk per trade is $100. You're willing to lose and risk $100 per trade. And then in this example, our planned risk per share is $1.80. I'm going to show you in just a second how I got that number. And so you're risking $100. You're risking $1.80 per share. And when you do the math, that means your maximum number of shares, doesn't mean you have to buy all these, but your maximum number of shares is 55 shares. So let me show you a chart real quick to show you how I got $1.80. Where did that come from? This is a chart of Chevron, and if you notice on Chevron, on this day, this was Friday, let's see, it's Monday morning while I'm recording this. So this was Friday, April 27th. This candle is Thursday, April 25th. And let's say Thursday, April 26th. Wednesday, April 25th, you saw this hammer candle right here. I'm going to get this out of the way for a second. You see that hammer candle right there resting on the 9 EMA? Chevron's in a nice trend. It pulled back to the 9 EMA. It gave you that long tail hammer candle right there. And you thought, that's a good place to take a risk on a trade because it looks like it's in this bullish trend and it's riding up the 9 EMA. Nice little trend there. So you would look at your chart and you'll see that the high of that day on that hammer was $122.90. You see that in the box there. And then the low of that hammer candle is $121.12. So let's say you want to buy whenever Chevron goes over the high of that hammer candle, and you will set your stop 1 penny below the low of that hammer candle. So again, just to look at what those numbers exactly are, the high, 122.90. So let's say you put in a buy order, or you're going to manually buy it if you're watching it. You're going to buy Chevron at $122 $1.91, 1 penny above the high of that hammer candle. And you're going to set your stop 1 penny below the low of that hammer candle. $121.12 was the low, so you're going to set your stop at $121.11. So you subtract $122.91 minus $121.11, and you get $1.80. All right, so that's your risk, and you can buy 55 shares of Chevron. So let's say you buy 55 shares of Chevron CVX at $122.91. That's $6,760.05. If it doesn't go up, if it goes down and it hits that stop 1 penny below that hammer candle, you would sell. You'd have an order in. Your stop order would automatically sell when it hits your number. You'd sell 55 shares of Chevron at $121.11, giving you $6,661.05. You would lose $99. 67.60.05 minus 66.61.05 is $99. So you looked at the chart, you determined that was a good place to buy, and of course if you had done that, that would have been a nice little gain there for a couple of days, right? So you would set your buy 1 penny above the high of that hammer candle, set your stop 1 penny below the low of that candle. You figure your risk. In this case, it was $1.80, and then you figure that's how many shares you can buy. Now, let's take this a little further. If you had a larger, if you decided to go with 2% risk on a $10,000 account, you'd be risking $200, right? And $200 divided by 180 is 111. Now, if you were to buy 111 shares of Chevron at $122.91, that would be $13,643. Well, you don't have that much in your account, so you couldn't buy 111 shares of Chevron if you took a 2% risk. So again, this is the maximum number of shares. Doesn't mean you have to buy all these shares. That's the max that you can buy if you're risking 2% in this case. So what you would do is maybe you would buy 80 shares of Chevron. You could do that at the same price for $98.32. Now, I don't recommend that you would put all your money in one trade. This would be basically taking your entire account, putting into Chevron. But my point is, you can't buy the maximum number of shares in this case. If you take a 2% risk, you'd have to reduce it down to something within your account. I hope that may be a little confusing, but hopefully that helps you see that a little bit. So the main thing is understand this formula and understand that you write down your account size, determine your risk, 1 to 2%, maybe 5% at the most if you have a small account. That gives you the dollar amount you're going to risk. You go to the chart, you figure out where you want to get in, you figure out where you're going to get out, and how much risk you're taking there, and then that gives you the maximum number of shares. The big thing to remember is you just want to remember the pineapple principle. The pineapple principle is when you cut a pineapple, you first start by cutting off both ends of the pineapple. So when you are eating a pineapple, you cut off the top, you cut off the bottom, and you're just eating the middle of the pineapple. You just want to get a part of the move in any trade. You're not going to get the absolute bottom and sell at the absolute top. Like if you go back to the Chevron chart here, nobody's going to buy down here at the very bottom, the absolute low, and sell it up here at the absolute top. That's just not going to happen. If it does, it's luck. But any trader will tell you there's no way you're going to ride a trend all the way from the absolute bottom to the absolute top. But what you do want, you may not get it from here to here, but you want some of this. You want some of that move in the middle. And you just need to get a little bit of the move in order to be profitable. Same thing over here. You're not going to buy down here at this absolute low. You're probably never going to hit it at the absolute low, but you want to buy down here somewhere and ride it up. And you just want to get part of the move. So you want to get kind of the middle of the move. You're not going to get in, right there at the very beginning, and you're probably not going to get out at the very top, but you just want to get a part of the move. So just remember the pineapple principle, that you're not going to buy at the absolute bottom, you're not going to sell at the absolute top. If you get some of the move in the middle, you're doing great, but you'll rarely, if ever, buy the bottom or sell at the top. Last thing for this lesson is, taking small chunks and risking a little bit and making a little bit is all you need to do. We tend to overestimate what we can do in a short amount of time, and we underestimate what we can achieve over a long period of time. You're not going to make $1 million quick trading, but you can make a lot over time. You're risking 2%, and maybe you're making 2% or 4% or 5% per trade. Sometimes you'll do much more than that. But over time, just making a few percent here, a few percent there, just slowly increasing your account size, slowly increasing your trading knowledge and experience. And maintaining discipline and keeping your emotions out of the trades, like we talked about in lesson 8. Controlling your risk, protecting your capital, protecting your money. You can do well and make good extra money, or maybe even make a living one day at this. But just learn risk management, and truthfully, these two lessons are probably the most important ones in this series. You've got to learn to risk a little bit, to make a little bit, and maybe occasionally make a lot, in order to survive and continue being profitable with your trading. So hopefully this has helped a little bit, and we'll see you next time.